So I'm going to go ahead and do the introductions. So I'd like to welcome everybody to our presentation today. My name is Patrick Curtis. I'm a CPA. I'm a partner here at the firm, or shareholders we call them. Got over 23 years of experience, and I am sort of the lead on our outsourced accounting department. And I have my colleague Karis here. Karis, would you like to introduce yourself?
Absolutely. I'm a shareholder with the firm. I've been here for over 11 years and I lead our nonprofit audit department practice. So really excited to talk to you today about leases, get into some good details. And as always, if you have specific questions, things can get very complicated when it comes to this subject, and we're always there to help.
Yes. I guess a couple of caveats that we might want to say. We're going to take some we're going to take a very complicated subject and try to boil it down into easy to understand concepts. We're going to use some relatively simple examples. If you have questions at the end, we'd be happy to sort of get into any of the nitty gritty. It might be something we have to take offline because some of these things can get pretty difficult. Anyways, so our agenda today, we're going to go over who's impacted, when does the new standard, is it effective? We're going to have to identify what is a lease. So we have to define what a lease is. We'll have to identify those types of contracts that are leases. We're going to talk about identified assets, which is an element of lease, the right to control the use and sort of the right to obtain the benefits of that lease. Karis is going to talk about contracts multiple components. She's going to go over lease classifications, the terms, the payments, all of the examples on how to do things. So Karis is going to prove that she knows much more about this than I do. I'm going to talk theoretical, and she's going to show you the actual way to do things. And then at the end, I'll pick up a little bit and I'll talk about some tax implications. As Karis said, at any point, if you would like to ask a question, please put it in the Q&A. One of our colleagues here will send us a note letting us know if there's a question, and we'll either try and answer it during the presentation or we'll circle back at the end.
I'll try to leave 10 minutes at the end so we can kind of go over questions if anybody has any. If not, Patrick and I will just make up our own questions. So we'll see what happens.
We will talk. All right, next slide, please. Okay, so I'm going to start with this, and I'm going to talk about some of the theoretical. And let's just stop for a second and say why. Why are we having this conversation? And I think that's probably the most important thing. So the previous guidance, which was ASC 840, before the ASCs, it was FAS 13, has been replaced with ASC 842. ASC 840, essentially you had two types of leases. You had operating and you had capital leases. Operating leases were not recorded on the balance sheet. There were no lease liabilities. There were no assets. There was only disclosure of your leasing activities in the notes to the financial statements. With respect to financing leases, or capital leases, you would record an asset and a liability, and you would recognize expense over time. There would be a component of interest expense. There would be a component of amortization expense. By and large, that hasn't changed. But what is new is that ASC 842 says, well, we're going to take that operating asset, that operating lease, and the finance lease, and we're going to put them both on the balance sheet. So that's what we're here to talk about today, is what the impact is on you. And we're going to do this primarily from the perspective of a lessee, not a lessor. That's typically the clients that we're working with, and we're hoping to help the majority of the clients on this call today. Okay, so next, when is the new standard effective? Well, that's a very interesting question. It's already effective. And it was effective for public companies back in January 1st of 2019. That's when they had to implement. For non-public entities, the actual date was for fiscal years beginning after December 15th, 2021, which means we should have done all this work on January 1st of 2022. However, like most accountants and like most business owners or whoever you might be, or organizations, we've all procrastinated. So here we are on February 8th of 2023, and we're beginning to implement now. And we're going to go back and we're going to say, well, this is what we should have done on January 1st of 2022, and we're going to record that in our books. And that's what we're here to talk about and kind of help you do today. Next slide, please. Okay, so I guess the first place to start is, what's a lease? Well, a lease is a contract or a portion of a contract that conveys the right to control the use of an identified asset for a specified time frame. And that relatively simple sentence gets broken down into many pieces with the new standards. It's actually quite complicated. But let's go on to the next lease, the next item, and we're going to talk about a decision tree. And the decision tree essentially applies to contracts. So anytime you get a contract these days, you have to determine whether or not there's a lease. Either the contract is a lease, or it's a contract for something else and there's a lease embedded. So you have to be cognizant of these items when you're determining whether or not you do have a lease. And I'm going to go through this decision tree and kind of talk about how you do that. And the first one will be, whether or not the contract, there's an identified asset in the contract. If the answer is no, then we do not have a lease. If the answer is yes, then we have other decision points. So let's go to the next slide, please. Okay, so identified assets, they must be explicitly or implicitly identified. They can be a physically distinct portion of a larger asset. However, they couldn't just be the capacity portion of a larger asset. So physically distinct means 7th floor of a building. Capacity portion means unused portion of a pipeline, where you can't really specify what I'm getting. There has to be specificity, I hate to say that word again, as to the asset which is identified in the contract. And then, so let's say you've gotten a specific asset, or you have a physically distinct portion of a larger asset. If the lessor has the right to substitute assets, that could also result in you not having a specified asset. And if we go to the next page. Next slide, please. Oh, I'm sorry, let's go back 2. Okay, so is there an identified asset? Well, if there was, then you're going to move on to the next slide. If there wasn't, then the contract does not contain a lease. Let's go ahead and skip forward to. All right, so these are the types of things that you'll see in leases, and I'm sure most of you are familiar with this. Buildings, airlines lease a lot of airplanes. Ships can be leased, containers can be leased. Equipment, heavy equipment, certainly is something that's going to be part of a leasing activity, and then you can even lease manufacturing facilities. There are certain items that you'll find in contracts that are not items that are not considered leases. So a contract for an asset under construction, not a lease. Contract for an intangible asset, not a lease. Contract for biological assets, to include things like cows, not leases. If you lease a facility that has inventory, that inventory is not part of the leasing activity. It would not be determined, would not be used in determining the value of the liability or the value of the right of use asset. And then finally, non-regenerative resources, things like trees or timber and petroleum and coal. Those items would not be part of determining whether or not you have a lease. Next slide, please. Okay, so back to our decision tree. Let's assume that we've gone through the process, we've got our contract, we do have an identified asset, we're going to lease the floor of a building. The next question is, does the customer have the right to obtain substantially all of the economic benefits from use? And then who has the right to direct how and for what purpose that asset is used? Can you go to the next slide, please? Okay, so the right to control the use and the right to direct the use of the asset. The first thing is you have to have considerably all of the economic benefits from use. And that can either be the use of the asset directly or indirectly, and the economic benefits from the use of that asset to include its primary output, its byproducts, and most importantly, the potential cash flow that's generated by that asset. Because typically you're leasing items that will generate cash for you in your business. And then the right to direct the use of the asset. Well, now that we've determined that we have the right to control the use, who gets to use it and for how and for what purpose? Generally speaking, it's either going to be you or the lessor is going to have the right to control it, although there could be instances where no one controls the asset. If you, the organization, has the right to control that asset, you control the economic benefits, then you have a lease. If you control the economic benefits, but you don't control the use of the asset, well, it could be a situation where the asset was constructed specifically to meet a particular purpose using a particular methodology, meaning it's sort of ingrained in the asset, it controls itself. And if you were part of the decision-making process in designing that asset, well then, can you go back one more slide, please? So, and we're going to talk about step 2. Do we have the right to do we have the right to obtain substantially all the benefits? The answer was yes. If it was no, not a lease. Do we have the right to direct how and for what purpose the asset is used? If the customer does, then it's a lease. If the supplier does, then it's not a lease. If neither of you do, well, then the question becomes whether or not the asset was designed for a particular purpose, and then who has the right to operate it. If it's the customer, then it's the contract contains a lease. If it's no, the customer doesn't, but they designed the asset, then the contract contains a lease. If they did not, the contract does not contain a lease. A little complicated. Probably none of you will run into that problem, but I wanted to go through it. Typically, most of your leases are going to be, I have a lease for a piece of equipment, I leased a floor in a building. And that's a very easy determination as to whether or not to get through this decision tree. Next slide, please. Okay, the lease term. So this is important because if you have a lease that is less than a year, meaning short term, then you can make a policy election which would essentially say, well, we're not going to include any of these leases on our balance sheet. We're going to recognize them expense on a straight line basis, and we're not going to include a short-term lease in our balance sheet. If you make that policy election, it goes for all of your short-term leases, and then it's important to understand what a short-term lease is. So the lease term, it's the non-cancelable period plus a renewal options that are reasonably certain to be exercised by the lessee. Meaning, the renewal option gives you a discount on the use of the floor. Maybe your lease goes down. It's one of those things you can't refuse. A termination option that's reasonably certain not to be exercised. So let's assume you had a lease for a year, but there's a termination option which you had to pay $100,000 to get out of the lease that only cost you $50,000 in a year. Pretty certain you're not going to do that. It's better off just paying the lease, and you would cost you less money, and you continue for a year. So in that circumstance, you no longer have a short-term lease, you have a long-term lease, because your 12-month lease, you have a termination option you're not going to exercise, so now you have a 24-month lease. And now that practical expedient, that policy election doesn't apply. We've gone from short-term to long-term. And then finally, there are options to extend that are not controlled by the lessee, but they're controlled by the lessor. Typically, a lessor is going to go ahead and exercise those. So that would be accounted for when you're determining the lease term. Now that lease term, once again, is going to tell us whether or not we have a short-term lease, and it's also going to tell us which of the payments we have to include as we're determining the lease liability and the right of use asset. Now, if during the term of your lease, significant events happen, you may have to reassess the term of the lease, you may have to reassess the payments. So let's say you had a modification that you had to lease more floors or whatever it is, and you have to go through this process of reassessment requirements. I'm not going to go through that today because we're looking at a very simple example, but that is something you have to be concerned with. Next slide. All right, now we're going to move on to contracts with multiple components. And as I told you, Karis is going to do most of the heavy lifting here today. So I'm going to turn it over to you, Karis.
All right, so now that we've identified the asset, we know that we have the right to control it, we understand the lease term, we're concerned about, are there multiple components within the contract that we have to account for separately? So when we think about these separate lease components, it is a separate lease component if the lessee can benefit from the use of the underlying asset, either on its own or using other resources that are readily available. The underlying asset is not heavily dependent on or highly interrelated with other assets in the arrangement. And an activity is a non-lease component if it transfers a good or service to the lessee. So all of these things need to be thought about when we're looking at all the components within the contract, particularly with a lease that we see for space. We see real estate taxes, utility payments. These things can be incorporated within the lease documentation. And it's important to note, should these be included within the lease liability calculation or not? Next slide. So a step-by-step process when looking at these separate lease components, when breaking down the contract. Step one, determine the consideration in the contract. Are there any fixed payments? Are there any variable lease payments within? And how are we going to account for those? For fixed payments, they are going to be incorporated, with variable lease payments typically not included unless there is an index or rate within. Determining the basis for the allocation, the standalone prices for each individual component that could be defined within the contract, or you might have to allocate those prices within. And allocating the consideration in the contract to each component finally. So really understanding what the lease liability will be versus your non-lease components and the value of those two things. Next slide. So here's a very simplistic example. We've got a lease payment total of $25,000. So we've got rent and maintenance. Again, this could get very complicated. There's multiple components that could be included, but here's just a simple example of how to really, break these components down. So the first question, how many components are in this contract? And what is the lessee's consideration in the contract? So slide 2 for the example. So we have two lease components. We have two components. We've got the lease component and then the non-lease component, which is utilities, the maintenance costs associated with this contract. And below, we're allocating the percentage of the standalone selling price for the individual components themselves. So the $21,950 that we see here, that's what we're going to use as the rent payment that we're going to use for the calculation of the lease liability. And we're not going to include the maintenance costs associated.
Wait, no, Karis, just so maybe a lot of folks here haven't gone through 606. Determining the standalone selling price. But as you can see, the standalone selling prices don't total up to the $25,000 of total consideration. So we have to take the standalone selling price, and then the missing piece of $500 has to be allocated between the two things based on the percentage of the standalone selling price to the total. So really what we're allocating is only $500. The rest of it is something we could glean from market information, things of that nature. Is that about correct there, Karis?
Right. And again, we're doing this because we want to understand what the lease component will represent. So what is the lease payment that we want to use to calculate our lease liability? That's really the purpose of this slide and this understanding of the example here. So if we go on to a differentiation between types of leases. So now we have two types of leases, operating leases and financing leases. An operating lease implies that the lessee obtains the use of an asset for only a period of time. And a finance lease implies that the lessee has purchased the underlying asset, even though that might not actually be the case. So previously, a finance lease was really called a capital lease, and operating leases are pretty much the same as they were, except now we're including them on the balance sheet. So we have to account for that differently than we previously did in ASC 840. Went on to the next slide. So what is a finance lease? Previously, when we thought about capital leases, we had 4 criteria. Now we have 5. If the lease transfers ownership of the underlying asset to the lessee by the end of the lease term, then it's a finance lease. If the lease grants the lessee an option to purchase the underlying asset that the lessee is responsible for and is reasonably certain to exercise. So if there is a bargain purchase option, maybe with a copier lease, then it would qualify as a finance lease. If the lease term is for a major part of the remaining economic life of the underlying asset. So previously we had a 75% standard. Now we have a more, a major part is what is determined now. So that leads to more variability as to what major part really means. But it is, we can think of it as that 75% previously identified in the previous ASC 40. $840. So the present value of the lease payments and any residual value guaranteed by the lessee equals or exceeds substantially all of the fair value of the underlying asset. Previously in ASC 840, it was 90%. So there is some judgment as to what substantially all means when it comes to the standard. Additionally, if the lease asset is so specialized in nature that it is expected to have no alternative use by the lessor at the end of the lease term. So if any one of these apply, then it is considered a finance lease.
Can I add just one little
Sure.
thought? So first of all, I remember memorizing those 4 components of how to determine a capital lease. It was one of those things that you wore as a badge of honor when you're taking the CPA exam. That's all gone now. I'm feeling old. But in our industries that we serve here at Rubino, which is government contractors and nonprofits and perhaps nonprofits that have government grants, there was sort of this predetermination or this predisposable to try and avoid a finance lease because of the interest component. Interest is not an allowable cost under the FAR Part 31, and it can be considered unallowable under the nonprofit cost principles. And while I think that still exists, that sort of issue is still there. So as you're negotiating these leases, you just want to keep in mind, and you have a little bit more judgment now, right? What is the major part defined, and what is a substantially all the fair value of the underlying assets? You don't have that bright line. You can, I don't want to say fudge it a little bit, but you have a little bit more judgment, right?
Yeah, absolutely. And this is more in line with the International Accounting Standards Board, how they look at things. That's a broader perspective, as opposed to, GAAP, which is very rigid in the sense that it's 75%, 90%. This is really joining the two and saying, let's use a little bit more judgment when it comes to identifying if it's a finance lease or not.
I believe that's principles-based versus rules-based. Is that right?
There you go. There you go.
Okay.
If we move on to the next slide. So understanding the differences between a finance lease and an operating lease. If we are using a financing approach versus an operating approach, for both, the balance sheet is going to be the same. It's really the income statement recognition and the timing of how we're going to recognize the expense over the life of the lease. For expenses, the finance lease is going to be front loaded because the lease liability is going to be higher at, of course, the beginning of the lease. So interest will be higher at the beginning of the lease versus at the end of the lease. For cash flow purposes, we'll have an operating and financing component. For operating leases, we'll just have the operating component for the cash paid for the lease payments. The pattern of expense for operating leases will be straight line, so it will be lease expense over the life of the lease. And now we'll look at...
Real quick, we did have a question, if you don't mind. It's a good question, Vivian. And Vivian asked, what if a lease specifies a purchase at fair market value at termination? So fair market value, it's not a bargain purchase option. It doesn't transfer the actual ownership. Can you go back to the previous slide, please? So the lease grants the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise. That assumes that there's a bargain purchase option, or it assumes that the lease is just transferred, or the ownership transfers. So fair market purchase or fair market value would not
be a bargain purchase
presume.
option.
Yeah, it's not reasonably certain exercise. So you're still in the operating section there versus a finance lease.
Right.
Is that correct, Karis?
Yeah,
Good.
absolutely. Absolutely.
Good.
Yeah, good call there. And
there's Meredith,
a question about the copies of the slides. Yes, you will get the copies of the slides at the end of the presentation, at the end of the call today. So now that we've determined what the classification between an operating and finance lease is, let's go on to the next slide. So here's just a little diagram to go over the differentiation between the balance sheet, income statement, and cash flow for a financing versus operating lease. The balance sheet is the same, income statement will look a little different, and cash flow will have that financing component for the financing lease. The next slide. For the lease accounting model, so at initial measurement, we have to determine the lease obligation. The present value of the lease payments not yet paid will be our lease liability and determine our right of use assets. And that includes the obligation, the lease liability, plus any initial direct costs, minus any lease incentives. This would include any deferred rent, plus any prepaid lease and payments. So all of these things need to be included within the right of use asset upon when you actually enact the standard. It's again important to remember for short-term leases that if you do have a lease that's not over a year, you need to disclose that within the financial statements, but we're not including that within the balance sheet or income statements. If you do have an option to extend, you also need to assess is that really a year-long lease or is it longer, as Patrick talked about.
Clarify one thing. Right. So that's a policy election. I recommend that you all adopt that policy election versus taking the time to put these short-term assets on your balance sheet. So there you go.
Yeah, absolutely. Okay, so moving on. When we look at lease payments, there could be aspects of the contract that are both fixed lease payments, any variable lease payments, residual value guarantees, purchase and termination options. We're not going to go through all of these today, but really understanding the contract and understanding what fixed lease payments are in place. If there are variable payments, are they going to affect the lease liability calculation? If there isn't an index or rate, then no, they most likely will not affect the lease liability calculation. Residual value guarantees, how will that affect the liability? And any purchase and termination options, do these need to be included when we calculate that lease liability? Next slide. So when we talk about the discount rate here, we now have the ability for a non-public entity to make a policy election that they're going to use the risk-free rate of return. If you don't have an internal borrowing rate, which is pretty common, I would say, for most of the entities that we've seen, this usage of the risk-free rate of return is a lot easier for organizations, for companies to implement than to try to determine their incremental borrowing rate, try to get a rate from the lessor. That does need to be disclosed within the financial statements, the policy election, but it's important to note that using that risk-free rate of return, looking at treasury rates and understanding what that rate will be, as opposed to having to internally determine that rate yourself. All right. So let's go to an example. This is very simple, but we'll walk through both an operating lease and a finance lease. And we'll use the same example for both. So it's going to be the same example, but we'll look at the journal entries for both financing and operating. If your company leases a truck for 3 years, you'll make payments of $20,000 per year. The first payment is due on the start of the lease. The residual value of the truck is $15,000 at the end of the lease. There's a 10-year treasury rate at 3.67%. That's the rate that we'll use for the discount. So for the present value of the residual value of the truck, we'll incorporate that and the present value of the lease payments. That will get us to the fair value of the truck. So the fair value of the truck, the combination of the residual value and the present value of those lease payments is $71,364. So the lease payments are 81% of the fair value of the truck. Now, previously, the standard was 90%. So is this substantially all? That would be the determination that you have to make. You know, and Patrick and I have debated this, whether, you know, you would have to look at this now as, you know, yes, it is a financing lease or it's an operating lease. If you go to the previous standard, that it would not be a finance lease, it would be an operating lease.
What we would do under the previous standard is we would mess with the economic useful life to get the answer we want. But in this case, we're just using our judgment, right?
Very good. Yes, very true. Okay. So for this example, if we move on to the next slide, we're going to use an effective interest rate table for both the operating and finance. And we want to do that for both calculations. So at the initial lease liability, at the start of the lease, it's $57,000. And we're going to call this interest on the liability. Now, we're not going to record interest for the operating lease, but we are still going to call it interest, and it will affect how we calculate it. So let's look at the journal entries for the finance lease. So for the finance lease, we'll record a debit of the right of use asset for the full $57,901 and the lease liability for $57,901. When we initially make the payments, we will debit the lease liability and credit the cash. And for interest expense, because we are doing the finance lease, we'll record that interest at the end of the year for $1391. The amortization expense will be the same throughout the life of the lease. Similarly, at the January 1st, 2023 date, we'll record the payments, and then we'll, at the end of the year, record the interest and the amortization expense. The amortization expense will remain the same throughout the life of the lease. And finally, we've recorded all of the interest at that, January 1st, 2024 date. So we're not going to record any interest, but we are going to record the remaining amortization expense and the reduction in the lease liability, which will get our right of use asset and lease liability to zero.
Okay, and just can I point out real quick that if you go through the exercise of adding all these numbers up, you're going to have, it's $60,000 just going out the door,
right? And
you're going to have $60,000 of expense.
Exactly.
57.9 of it will be, or whatever the number is, $57,901 of that will be amortization expense, and the remainder will be interest expense. And that'll just be a little bit different in the next example, which I'm going to stop talking for now.
Yeah, and that's a really good point, Patrick. And we are looking at this at the present value. So that's why we see a difference between the payments and the calculation of the right of use asset lease liability, because we did do the present value calculation, and that's how we're getting to our lease liability total. So there is some element of interest. So when we do look at operating leases, it is going to look a little bit different. We have the right of use asset for $57,901. That's not going to change. And then the lease liability, when you actually make the payment, debit to lease liability, credit to cash, this is where things get a little different. For each time we're reporting lease expense, we're reporting lease expense as opposed to reporting amortization and interest expense separately. So each year it will be $20,000 for lease expense. Our plug here is going to be the right of use asset. So the lease liability will be reduced by what we consider, or lease liability will be increased rather by the value of the interest, and the plug here is going to be the right of use asset to get us to that 20,000. So it does look a little bit different, but it is a similar calculation for both, and we want to use the same table. At the end of the period, we will essentially get to the same amount of expense for each. The finance lease is going to have more upfront because our lease liability is greater at the beginning of the lease, and the operating lease will have the same expense throughout the life of the lease. So it is looking a little bit different, and year over year, but at the end of the day, we're still going to have the same amount of expense. Now there is a dollar rounding error here, but that's, that's the only difference between these two calculations. All right, so when we think about transitioning to the new lease standard, really understanding the basic lease terms and assumptions, getting comfortable with contracts that are in place, understanding what leases you have and what potential agreements don't qualify as a leasing arrangement, establishing the population, the transition method that needs to be used, and any relevant provisions. If you are choosing that, today, you're looking at things today versus going back in time, that transition method, that would be a better approach. And we want to make sure that, we're establishing which transition method and including that within the financial statements when we disclose our transition to this leasing standard. Identifying the lease term today, is there anything else that needs to be included within the lease term that wasn't included when the lease was initially enacted? What is the total value of the lease term over the life of the lease, and including any option years or things of that nature? Identifying lease payments and calculating the related expenses. Are there variable payments? Are there fixed? Do we need to include additional calculations within this? Determining the remaining lease payments. This will help us and get us to the initial lease liability, the remaining lease payments within the leasing arrangements. Finally, going through calculating the initial lease liability, that will be the present value of the remaining lease payments. And that's how we'll get to the initial lease liability calculation, calculating the initial right of use asset, that will be the lease liability, plus or minus any sort of changes like the deferred rent, direct costs that have already been capitalized, and then finally recording this initial entry. So moving on, the lease liability, and we'll just break down a couple of these things because the lease liability and the asset, that right of use asset, are really the things we want to get to at the end of the day. The lease liability here is measured at the present value of the remaining minimum rental payments using a discount rate for lease established at the application date. So the discount rate can be that treasury rate. You don't have to have that internal rate of borrowing in order to determine your discount rate. For the right of use asset, the amount of the lease liability, so we'll start with the lease liability and then adjust for any prepaid or accrued lease payments, the remaining balance of any lease incentives received. So this could be a build out lease lump sum. We need to calculate these within any unamortized initial direct costs and any impairments. The remaining balance of any lease incentives and the unamortized initial direct costs is probably the most common items that will need to be included within the right of use asset calculation. So here's just a little diagram. You start with the initial lease liability, subtract out your deferred rent liability, plus any unamortized initial direct cost, minus any unamortized lease incentives. That gets you to the right of use asset. That's a lot of variables, a lot of factors, but really understanding at the beginning of the year, when you were supposed to enact, so January 1st, 2022, where are we starting with the deferred rents? Where are we starting with the unamortized initial direct cost? Any unamortized lease incentives? Where are we starting with all of these pieces of the calculation?
Yeah, and folks, if you guys have questions about this, we're happy to kind of help you kind of work through some of these things. I would recommend you call Karis instead of me because she's probably much better at it than I am, but I could probably help as well. So just afterwards, we'll send you the lease, we'll send you the slides. If it's still not quite clicking, just shoot us an email. We'll be happy to help you out.
Right. So thinking about the financial statements and the disclosures within the financial statements, you'll have to disclose the nature of the leases, information about leases that have not commenced, any related party lease transactions, any accounting policy elections regarding short-term leases, and the accounting policy regarding how you implemented the new standard, finance and operating lease cost, and the discount rate used in the lease term. So we have an example here of what that looks like. This is just a short example of what's included in the accounting policy footnote for an entity. So this is, a disclosure and includes all of the necessary disclosures that have to be within that footnote. That's just the accounting policy itself. It's not the actual lease disclosure of what the asset and liability is, but it goes through the actual accounting policy here.
And there might be a slightly different note if you had a financing lease versus an operating lease.
Absolutely.
Which wouldn't be significantly different than what you had. So.
Right. But the example in here is an operating lease. So, there aren't any financing leases for this example. So, but that is a good example of what an operating lease is to take a look at. All right.
Okay, so I think it's my turn to talk again. And so I'm going to talk about a couple of the other key provisions, and then I'm going to go into a couple of odds and ends. So if you have a lease and you have a sublease, you're the lessee and then the lessor, those two things have to be accounted for separately. You're not allowed to net the two items together. So that's probably one of the more important things and probably a real life example of what could happen. Related party leases, we do run into this quite a bit. That should be accounted for in the basis of the legally enforceable terms and conditions included in the lease agreement. We are not going to look at the substance of the transaction because it could be very different than the actual enforceable terms. And this, of course, will be subject to disclosure as a related party transaction under ASC 850. Leasehold improvements are generally going to be capitalized and amortized over the shorter of their useful lives, the remaining lease term. unless the lease transfers ownership at the end of the lease term, or it's reasonably certain that the lessee will exercise the purchase option, in which case you're going to use it over the estimated useful life of the asset. Go to the next slide, please. Tax implications. Now, this is my favorite thing. And all you nonprofit organizations, your eyes are glazing over right now, so I apologize. And all you for-profit entities that are pass-throughs that don't have to deal with actual tax of a corporation, you're sort of glazing over as well. But there are items in this particular ASC 842 that are going to create differences between books and tax. So the lease liability that we're going to record on the books and the right of use asset that we're going to record on the books, neither one of those is going to be recognized for tax purposes, which basically recognizes the expense on a straight line basis. So we would have to create a deferred tax asset and a deferred tax liability for the two items. Those two items do get offset for purposes of disclosing your net deferred tax asset or liability. By the way, those two items will never be the same balance as you're going through the calculations. It'll always be slightly off. So you will have a net DTA or deferred tax asset or deferred tax liability that will then create a book to tax difference, which could, if material, create a deferred tax asset or liability in your books. And this also might impact the computation of state and local income tax as a result of the apportionment formulas. So having all those assets on your books, when you book that right of use asset, and that asset is in the wonderful state of Maryland, which has a very high corporate tax rate, versus the state of Virginia, which has a much lower corporate tax rate, that could have a negative impact on you in that your apportionment factors, there's a 3-factor formula, total assets, total labor, and total sales in a particular jurisdiction. What most of you would like to have is you'd like to have your apportionment skewed to the less expensive jurisdiction, but these lease assets will then impact the allocation of income between jurisdictions. Next slide, please. All right, this is just kind of a little recap. The roadmap was number 1, identify your lease population. If you're on this webinar, you are way behind. So start today. Get out there, grab all your leases, get your contracts, read them. Do your technical analysis and assessment. That's the reading. Identifying anything in your contracts that could be considered a lease or is a lease. You want to do your calculations and then validate your data. At the end of the day, these things should net to zero. You know, as you're sort of doing all your calculations, there shouldn't be a residual value at the end, right? If you've got an amortization schedule and that amortization schedule has a right of use asset at the end of 30 years of your lease and it should be zero, then you know something's wrong in your mechanics. And then pull out your calculator and start working at it again. Okay, well, I think at this point, we do have some time for questions. And we've already gotten 2 very good ones, but we'll just kind of sit here for a few minutes and see if anybody else has any questions.
And I'll add, Patrick, with that roadmap, it's important to look at that on a yearly basis. You know, when we think about internal controls for leases, because this is going to result in, you know, an asset and a liability each and every year, there could be the potential for a lease to change, a new lease to be added. Looking at these things on a yearly basis and saying, do we have any additional calculations that need to be made or amendments that we need to be making to the old calculation? This isn't a static, you know, calculation. It might change over time.
I agree 100%. So look, folks, it doesn't look like we have any particular questions. You know, we were very happy to be able to present this topic to you. You know, there are entire industries out there now that are here to support leases. Organizations have created brand new sort of software packages. Here's a good question. We are a nonprofit organization, are leasing our office. Do we need to be compliant with this? The answer is yes. If you need to have an audit or if you need to prepare GAAP-based financial statements, then you do. And what we've just described as the process is figuring that out. David Robinson, very good question. With regard to the discount rate, Treasury was mentioned along with the lessor's rate. Are we able to determine which one to use? So our recommendation, David, is that you look, if you don't have a line of credit with a internal borrowing rate, so if you had a line of credit, you knew that you have a 5.5% internal borrowing rate, meaning if you went out for more debt, that's what the rate would be. You can use that. If not, you're never going to find out what the lessor's rate is. They're just not going to tell you. Maybe they disclosed it by accident somewhere in the lease. If they did, it was by accident, trust me. So in that situation, what you want to do is you want to use the practical expedient, and the practical expedient is the risk-free interest rate. There are several potential sources of that. The 10-year Treasury generally is a pretty good estimate of risk-free interest rate, and you know, I think Karis and I would just recommend using that as your interest rate in all situations.
Absolutely.
And you would do that as of the implementation date for the lease. All right, well, good. Well, we had a flurry of questions, so I don't want to jump off yet. We'll give it another minute, and then we will let you all enjoy the rest of your day. By the way, I'd like to thank Nicole Simic and Amber Rohde. Nicole has been behind the scenes, making sure Karis and I got all our work done, and Amber has done some of the graphic work. Actually did all the graphics, so it looks great. So thank you both.
Thank you.
Meredith, thanks for the comment. All right, everybody. I hope you all have a great day. If you need us, just reach out. We're happy to help. And you know, if you really want to go, you can just search and find some of these solutions online to help you calculate things. It's not that hard. Just do it in Excel would be unless you have 100 leases, in which case maybe you want to buy a software package. All right. Take care.
Thank you all.
Bye.